Welcome back, and it's time for another TIP TV CEO interview. I'm Malcolm Graham Wood, and today returning is Jay Cheatham from Pantheon Resources. Welcome to you, Jay.
Thank you, Malcolm. Glad to be back with you again.
Let's not beat about the bush. It's been a pretty grim few weeks for Pantheon and the people who believe the story and think that you've had a rough time. Why don't you give me your take on how things have happened on an operational basis, and then maybe I can ask you specifically what I think people's questions are.
Well, in Polk County, we learned we cannot drill horizontal wells efficiently. That's the bottom line in Polk County. We attempted it, what our industry tries to do and has been very successful over a very long period of time, is find ways to more efficiently drill and produce the resources out of the ground. Because of the industry had moved forward so much on horizontal, and we had been successful in drilling vertical well there and the pilot hole, we attempted a horizontal well, found that the rock was too hard and too abrasive, and we'll lick our wounds and go on.
So let's get this absolutely straight before. Does this tell me that no one has ever drilled a horizontal well in the Eagleford Sandstone before?
First time anyone had attempted to drill an Eagleford Sandstone horizontal well, yes.
And the temptation was obviously that if you could get the horizontal working, you'd get a more efficient way of producing the hydrocarbons.
Yes, we were hopeful that we would be able to, for 50 or 60% increase in CapEx, be able to produce 2 or possibly 3 times the ultimate recovery and thus flow rates out of the same wellbore.
Right. So this took quite some time of getting it wrong. You went through drill bits and diamonds and all sorts of things. The big question is, why didn't you stop sooner if you didn't think it wasn't working?
Yeah, well, we had multiple equipment failures, and when we drill vertically, we do all of that ourselves. We're not specialists in horizontal drilling. So you bring in a specialist horizontal drilling crew, you give them your well plan, you give them all the rock data that you have, the pore pressures, and they design a well plan. And what happened to us is we had about a dozen equipment failures that we shouldn't have had. None of them individually were terrible, but each time we have to make a trip to change out something in the bottom hole assembly. Yeah. It's about a 30-hour round trip.
Yeah.
Plus, you're not circulating the mud, so once you get back on bottom, you have to circulate to get your mud back the way you want it. And every week we have a call, and every week I was asked, well, when are we going to get to TD? And every week I was saying, once we get our kit working, we'll be there in 3 to 5 days. And finally, when we got our kit working and we drilled for that period of time and realized that our penetration rate, while the kit was working, everything was going right, was 1.5 feet per hour. It was just uneconomic to continue.
20/20 hindsight, you might have stopped a little earlier and sort of done that.
Surely, 20/20 hindsight would be great. We would have stopped earlier.
Okay, now you said that there were significant hydrocarbons in the well. So you flared for several days. You said in the statement that you de-risked the project in terms of gas and liquids. So give us a run through of that. What did you get? What was the pressure like? How predictable does the reservoir look as a result of this well?
Well, the bottom line is we have not changed our geologic model at all. In fact, everything that we saw enforced what we believe. So when you drill horizontally, you drill vertically offset to where you want to be horizontally. Well, we took the opportunity to drill our vertical pilot hole all the way through the Eagleford Sandstone. And by the way, drilling that vertical, we were ahead of time and $600,000 under our AFE budget on that. Then you cement that off so you have a kickoff plug. Yeah. And when we started in the horizontal portion was the building the curve and all was when we started having all the kit issues. So we logged the pilot hole, and we saw 35 feet of net pay, which was what our geologic model would have predicted. And then during the time period when we were actually in the zone, And when you're drilling horizontally, you don't know the exact thickness, but we were had a 25-foot flare when we were in the zone.
So when you come back to this, you'll actually be re-entering the same hole? Or?
We will come up and actually angle over and then drop down vertically, which we can do ourselves and hit the target where we want to hit the target now.
Okay. I think what I'll do now is have a word about the VOS one and the disappointing frac. Then we can come back to see all the various different wells that are coming up and so on. So the main disappointment about the frac job was that we were all expecting to see an increase in the flow rate, 2 times, 3 times, even 5 times. But that never happened. You explained away the process in the paper, in the results, in the RNS, by saying that you did obviously you fracked a small amount of a section of the Eagleford and the Austin Chalk, although that's certainly not fracking, I guess. But having done that, it was only a small part. Talk us through what happened on the frac job.
We decided for economic reasons, and also, if you try and frack a very large zone, remember we have 270 feet there, if you're going to try and frack all of that, you need to use diverter agents. And anytime you put diverter agents in, you run the risk of doing additional damage to your reservoir if they don't break back properly. So we chose to frack only the top 10% of that 270-foot zone. That's our most productive zone. We know that frack was mechanically successful. We saw it break down. We saw increased flowing tubing pressures post-frac versus pre-frac of about 30%, which means we know we've increased our the reservoir we're draining. And remember, and this is very important, that well was compromised by the heavy mud that was left on the formation. We know we had skin damage. We'll never know exactly how good that well could have been. Plus, it wasn't drilled in the ideal location. If you remember, we had flooding in East Texas, and we wanted to drill a well that was only about 2 to 2.5 miles offset to the LP2 well. We ended up having to step out 4.5 miles, and we think we got a little bit compromised on the permeability and porosity, which proved out.
So and we'll come back to other wells.
Well, we got about a 15% increase in our flow rate. That was disappointing. We were hoping for 2 to 3 times. However, if the well flows at the rate we tested, and we have some analogs that show that it should flow at that rate and actually possibly have increasing liquids as we drop the bottom hole pressure, it pays out in slightly more than a year. So it's certainly not a disaster.
So in fact, I'll just pick up on that because it's interesting, because I've had 1 or 2 people say to me, how do you make a statement that says a well like that will pay out in just over a year? Where I know you keep your numbers very close to your chest, but would you like to run me through how you think it works?
You can do the math. 5,500 MCF and some attendant liquids at today's gas price. Multiply that out, and we get about 7% of the gross revenue. A little over a year, you're getting $4.5 to $5 million.
So, and again, you're talking gas here, and in the announcement you said that you had 920 barrels a day of oil equivalent, which was the 5,500 scuffs, and measurable amounts of condensate. People worry that you're ending up not having any oil in this well, but talk us through the liquids on this, if you would.
Several of the wells and ones that we look at that are analog to this in the AA wells field, and there's no guarantee that this one will act like that, but we have indications that we will. Their liquid production actually increased over time as they dropped the bottom hole pressure in the reservoir. And when the lower permeability sand started feeding into the wellbore. And we know, as old reservoir engineers, your relative permeability to gas is much, much higher than the relative permeability to oil. And we've basically, in that top zone, gotten an almost infinite permeability in that top zone that is primarily gas.
And would that explain why you kept on reducing the choke size on that, or was that nothing?
No, that had nothing to do with it.
You just reduced the choke size to get more.
We wanted to see the reaction of the reservoir to the reduced choke size to see what our flowing tubing pressures would be. And that was very positive for us.
Excellent. I mean, obviously, people still talk this as an oil story, but you mentioned, we've talked about gas, and I want to just briefly talk about, your problems with the midstream people, the people selling gas and doing the work that's needed to sell it. The price is nearly $3 an MCF, and now you're talking about doing the processing yourself.
Yes.
And particularly if you could reference the cost of these facilities,
yes,
because I'm hearing $100 million or more, and you're saying it's $1.5 million. So,
all right, it's a very simple story. The midstream people wanted a gas processing fee that we are unwilling to pay, and to put in a skid-mounted unit wherever we put it, but the first one will go in Polk County after we test this next well, is under $1.5 million capital cost. And they say we can have them on site within 30 days, and we will test that hypothesis after the next Polk County well test.
Now, I know you're not telling people when you're going to be cash positive and flowing and everything else, but that is encouraging in the sense that that is the piece of kit that you need to be able to start doing that. Right. So people can stop worrying too much about the fact that, nothing's happening.
Right, and we built the pad for the number 3 well, and that's the well we spudded this week, large enough to accommodate the skid-mounted processing facility, Malcolm, and the tap into the gas pipeline is 1.5 miles away.
Okay, and that's good. The time is already running out, but I've got 2 or 3 questions I need to ask about. Right. Where we go from here in terms of the wells, because I know you've got this the central basin test and so on. Can you
we'll complete the well we're on now, the Blackstone Minerals number 3 in Polk County. Then we'll move to drill the Tyler County Center Basin test that will test 5.5 miles from our Smith well, 10 miles from the LP2 well. If that comes in, we will have proven up a very large aerial extent reservoir of 25 to 30 square miles. Very impactful for our company. Right. Just to that center basin. There's another 10 miles of that basin further on. It's easy to do the math. The AA Wells field is 6 square miles. So we will be proving up an aerial extent way larger than AA Wells, many times.
So effectively, and then after that, so you've then
then we'll go back and recomplete the number 2 well.
Number 2 well, as a vertical, and you've already got it, you know where you are.
We know where we are there. The continuous drilling, at some point, we'll want to add a second rig, simply because we'd love to have a rig working in Polk County and one in Tyler County. Leases are expiring assets. You look at what your leasehold is, you can either renew them or drill them.
Yeah.
And so we've got to balance that off. And the geologic model hasn't changed. We're still confident. Our partners are spending their own money. They're not spending shareholder money.
I'm going to come back to when we get our last, which won't be long the way I'm going. I need to know where you think you are financially, because another thing is people say they're running out of money. They spent a lot more money than they thought on the horizontal. Tell us the finances.
We raised $30 million in March.
Yeah.
We spent $6.5 million to increase our interest in Polk County by 8%. We have to pay our share of this first well, the horizontal well, circa $6 million gross. Pay for the frac, a little more than $1 million.
Yeah.
Now we're going to pay for our share of the number 3 well, which is $3.75 million now. Which has come down. Our share of that. Then we'll pay for our share of Tyler County, which will be about a $5 million well at most. It's a little deeper and higher pressure. We still have plenty of capital available to continue funding this program well into next year, and at some point we will be cash flow positive.
I was going to say, you can't say when. I'll have a bash at that and see what I can do without any guidance. But to me, with the gas that you've been telling us about, it's quite interesting. Before I ask you for your sort of wrap up, this hasn't been the ideal 2 or 3 weeks in terms of the way this was presented to the market, I have to say. We've all taken a lot of for believing the story and not having it. I said at the beginning of the interview, should you have stopped it earlier? should you have informed the market maybe that when you'd had some problems that this was going to be longer than expected, and the market then took it much worse than expected. The market cap has halved from the peak, although it's going a little better now. Would you have done anything different?
Okay, hindsight's real easy, but individually, every time we had to change kit, we believed, and that once we got the kit working, we were only 3 to 5 days away. Had we informed the market, we would have had to say, well, by the way, we're also flaring gas when we're in the zone. So, we attempt to take volatility out of the market. And yes, hindsight is real easy to say, well, you should have informed us earlier. And in retrospect, we would do it differently than next time.
Now, to finish up, we've got a minute or so to finish up, and what I want you to do is, you mentioned halfway through that you believe in the dream, you believe the story, you've got the numbers that back you up, although we don't see them because you're looking at other things to buy locally and so on. But tell me, a lot of people really believe this. The way the share price has moved and the way things have happened in the last week or two, a lot of people have lost money on the shares and everything else. But you still really believe that this still...
Yes, I do, and our partners do, obviously, because they're spending their own money. But let's summarize. This is exceptionally low cost. The VOBM number 1 well, which tested at 1,500 barrels of oil equivalent per day, costs $4.5 million. On a P50 basis, that's about $3 per barrel of oil equivalent. If we get a P mean well, which we believe we have a really good chance, we're down around $1.50 per barrel of oil equivalent. We think that's the kind of CapEx numbers that we will be looking at going forward, whether it's in Polk County or Tyler County. And remember, we know what the operating costs of these wells are because our partner has one on the acreage that we have under lease. We don't have an interest in it. It's under $10,000 a month. It's basically free. And because of the nature of the reservoir that we have talked about on this show, the wells produce almost, the original discovery well at AA Wells Field, 32 years old, still producing today with no artificial lift.
Brilliant. That's really helpful, and I know people who've had a bad time, will take some doing. I really appreciate the fact that you've come over to London, you've spoken to the shareholders, and you've taken the time out to come into the TIP TV studio. It can't have been easy, but you still believe the story. So, Jay Cheatham, thank you very much indeed for coming into TIP TV.
Thank you, Mal. Appreciate it very much.